Bring on board Shankar Sharma, market expert, joining us. Shankar, thanks so much for taking time out. We had to wait almost till December to have record highs in the year 2022. But nonetheless, we've really weathered the storm and look at where we are today. You said now's the time to romance the market. So is that the sentiment that you're going with even today?
Yes, 100%. If anything, it is becoming better with time. Now you understand, his or her nature, depending on what is your own gender. So you're getting more comfortable with, wanting to continue and morph this short-term affair into a longer-term relationship.
All right. And in this lovely relationship, tell us a little bit more about what it is that you're advising one do. Is it trimming exposure to some of the sectors that you have, given that there are also lots of bouts of volatility that we are ever so accustomed to?
Look, I mean, my view is very simple. There is no point trying to micromanage this relationship. So there are times when you need to micromanage a relationship. There are times when you develop faith in which you don't need to micromanage a relationship. And so as a spouse, you should not be asking, where were you last night? To either of your spouses. I think we have entered that phase with this market. I think this is a market that you can trust to deliver the goods. And I don't think we should be becoming too micro and saying that, okay, should I trim this? Should I exit this? Should I enter that? Should I rotate this? Rotate that? If you bought, as I've said for the last 6 months, bought a quality bunch of 25, 30 small caps, maybe 40 small caps, I'm sure if people followed that simple advice, I think many would be sitting on substantial gains, having erased the losses from November down until the lows of April, May. So I think this is no time to micromanage. Buy your quality of good quality companies. If they're not performing well, only then think of exiting them. Otherwise, stay put in the trade.
Look at the stocks that have got us to where we are. The likes of Adani Enterprises, ITC, M&M, those have been some of the top contributors. What do you make of the texture of the market, the exposure to some of these, high beta names in particular within the auto space?
So I don't own any autos. I mean, my hands are full owning a lot of companies which are supplying to the autos, like in the ancillary space, and there are other spaces as well. For a fund kind of investor, some of these stocks look good. By and large, in my view, the Adani group of companies have been, an absolute surprise pack for almost every investor. And given their, the FPO that they're going to be doing, a lot of the issues will be addressed in terms of the leverage and all that. I think, provided you're comfortable with the valuations, many people can choose to question that, but provided you are, I mean, I think, a number of them may well turn out to continue to surprise us on the upside. And, autos are a mixed bag, but I think by and large, they're still okay. Barring IT, which is itself in a bit of a bother because they are more attuned and oriented towards the US markets, themes which are playing on domestic consumption may well be better places for investors to look for, rather than companies which are thriving and survive or have thrived and survived on exports. Because data from the developed countries or from China is very, very problematic and very, very soft. So exports or export-oriented companies will probably not deliver the goods, in my view. Domestic-oriented companies will do far better.
Domestic-oriented companies, and the gainers since the previous record reflect that PSUs have been at the leading front, and that's where really the gains have been. And within this space, Shankar, there is a lot of opportunity. It's not just the banks. You have the railway capex theme, the defense stocks. Are you seeing merit on looking at some of these names as long-term opportunities?
I'm not interested in doing business with companies that do business with the government of India. So, I've avoided these sectors by and large over my investing career, barring exceptions like BHL in the 90s, which was a very different kind of company and different kind of trade. But other than that, I have not invested in companies which do business with the government of India, because single buyer risk is substantial and it is going to be problematic from all kinds of things: margins, payments, litigation, CBI raids, you name them. So, people are welcome to buy railway stocks or defense stocks. I'm not a buyer.
What do you think it's going to be, the factor that could really change sentiment? Because at a time when we're looking at the rest of the globe, crude oil prices, of course, supportive for us, but there is that looming concern regarding inflation. The Fed saying that they might potentially slow down. But where do you think there would be that key risk factor for the markets?
I don't think there's any risk factor. Inflation was obviously a problem because of which we corrected substantially. I think that risk is now behind us. I don't think you're going to get major shocks on the crude oil front. I just don't see any major huge derailment risk for our current bull market. There will be, of course, corrections here and there, but I think every single dip from here on in India is an absolute and total screaming buy.
Interesting. The last time you had also said that you would rather buy tomatoes instead of the Zomatos of the world, Shankar, but they are really singing the right tune, if you will, talking about the path to profitability. Is that changing your mind at all, or still continue to remain convinced that these are not going to be wealth creators?
I'm happy that they finally discovered their stock market, listed part of the stock market, needs profits. I don't know why nobody told them this before. They should have known this before going to the public markets and destroying lakhs of crores of wealth, which is what these startups have done. Somebody should have told them BCom first year level, knowledge. So it's good, they are coming around and finally figuring out that profit, EPS, ROE, cash flows matter. But I think they're a long, long way away from becoming sensibly valued, even if they were to turn profitable. Even if they were to turn profitable, sensible valuations in India cannot be at price to sales multiples or 20, 30, 40 times, or potential far out price to earnings multiples of 200, 250 times. And I don't think they are in the realms of rational valuations, right now, even if I assume that they're going to become profitable.
Shankar, you said you're not interested in doing business with companies that do business with the government. As of now, you're mixed when it comes to autos, but you like domestic consumption. Can you be a little bit more specific as to where exactly you're seeing opportunity in this market?
Well, I think real estate is a great opportunity if you find good real estate plays, because I'm very optimistic on the real estate market. In India, it's gone through a big bear market the last several years. I think real estate will surprise us on the upside. And because if real estate does well, it has a lot of downstream effect on a number of sectors. So right from building materials to services around real estate, all of them become very interesting plays. So a laminate company, a plywood company, a pipes company, all of them. I mean, there is a whole. It's like literally like an auto industry. If you like autos, then the ancillaries will do well. So if you like real estate, then all the ancillaries to real estate demand will do very well. So I just named a few: building materials, pipes, and TMT bars and stuff like that. And I've invested in a bunch of them, actually. So I've invested in a company called Kamdhenu Ispat, which is a leading manufacturer of TMT. I've invested in Rama Pipes, which is a leading manufacturer of pipes. I've invested in Sumit Woods, which is a very niche northern Mumbai suburbs real estate redevelopment company. So I'm walking the talk.
Really, and we had a chat about a month ago with Mark Mobius, and he was also talking about the smaller the company is, the possibility to get bigger is far more. And that's something that, as a strategy as well, that you have adopted and have looked at. So just for investors, I know you shared a lot of names, but looking at the kind of catch-up play that we're seeing with the broader end of the market, you're saying that there's a lot of opportunity still within mid and small caps, right?
Yeah, it's unlimited opportunity. I'm inundated by all kinds of companies, transactions, and I don't think the market is expensive at all if you look wisely and look carefully. There are any number of fairly reasonably valued plays in the small cap space. I mean, I can easily see anything between 15 to 25 very decent opportunities, all within below 20, price earnings multiples for decent ROEs and decent cash flows. So I'm spoiled for choice. It's really like, I'm at a huge buffet table and I don't have enough appetite or even the wallet to be able to eat all of them. I mean, just fantastic time to be in the markets.
So we're at 18,600 right now, Shankar. What does 2023 have in store for us? Are you tracking any levels?
So if you're asking me index level, I mean, that is fraught with danger and fraught from here on for the next several years in India. And that's, I think, the easiest way to understand this. Don't micromanage this relationship. Make this into a longer term relationship instead of it becoming, one night stands.
Right, Shankar, we'll take that advice. Thanks so much for taking time out and joining in and giving us your flavor of the market and where you're seeing opportunity. That's the take coming in from